Today we're talking about the trillion-dollar behemoth, the tech titan that lives up to its name, the one and only Big Apple. With their market cap over $2 trillion, which is unrivaled by most of their competitors, many have asked the question on whether Apple is still a sound investment. After all, with such a high valuation, where could it go from here? 3, 4, 5 trillion? It's impossible to say. I won't be answering that question directly, for I cannot predict the future any better than anyone else. That being said, we can look at where Apple stands today, the current momentum of the company, and how it might handle rough economic conditions. If any of that caught your interest, then stick around and let's dive into the fundamentals of Apple. As common practice, we'll start with an overview. Apple is in fact a tech company. Yeah, who knew? With a main focus on device sales, ranging from iPhones, iPads, MacBooks, AirPods, services, and accessories that complement all of those products. The other big categories are primarily the App Store and its payment transaction fees, along with its new foray into services and subscriptions, which has been growing continuously despite the shaky quality. Must be that monopoly of Tom Hanks they got going. That being said, Apple has been a lot more diversified in recent years, and it knows how to make money. It's come a long way since the iPhone sales started to flatten off around 2015, with relatively slow growth since then, excluding the pandemic upticks at least. It wasn't that long ago that everyone thought Apple was tied to the fate of the iPhone, a one-trick pony in the legacy of Steve Jobs, a notion that Apple has clearly destroyed and flattened since then. Tim Cook has no issues roasting up some haters. Now let's get into the good parts, the financials. I can hear everyone who took Finance 101 getting all excited in their seats. And with $400 billion in revenue last year, that is basically as good as you can get as a company. And technically, it's not even as good as it gets, because there's not a real sign that Apple can't actually beat that again in the future. Maybe not with the current economic conditions, but with multiple product categories still showing signs of strong growth, it is very well possible. And if Apple actually makes its full priority its service sector, then it could have a pretty strong run ahead of it. Because let's be honest, Apple TV has definitely not been the priority. Not to mention Apple hasn't even started to touch gaming besides its App Store. Which may sound funny at first, but with the M series, they could go all in on gaming with just the SoC chips. Because let's be honest, it doesn't need to beat a NVIDIA graphics card, it just needs to be good enough for people to enjoy the experience. And historically, Apple is good at selling an experience, especially one that's simple, intuitive, and easy to use. Another strong signal for revenue is that Apple hasn't even saturated its home market. A few reports have shown that iPhones are actually growing in market share in the US. It's a small percentage, but it's still the fact that they're still growing in their home market. iPads have been dominating the tablet space. The M series has also caused a resurgence in MacBook sales, and the lineup hasn't even been fully developed yet. So the conclusion is that Apple is not capped out yet, at least not in revenue. And the numbers don't stop there for Apple. With $190 billion in gross profit, that's a big number to wrap your head around. Another way of saying it is that Apple's $2 trillion valuation is only about 12 times their gross profit. And that's if their revenues or profits didn't continue to grow. The slightly more realistic number to use would be the net income, which is still at basically $100 billion as of last year. And like mentioned before, the pandemic numbers are going to be hard to repeat in the next year or two at least. Therefore, Apple's $2.2 trillion valuation is about 22 times their net income. So if you wanted to compare it to other companies, that might be a good number to use. If you compare it to a similarly strong growing company, that is. That being said, Apple's current $25 billion spend on R&D could increase if it went into new sectors. That could range from a stronger focus on Apple TV, gaming, or a new product category. Where are my Apple glasses? I want to look like Tim Cook right now. So unsurprisingly, Apple's financials are absolutely fantastic. Maybe it does deserve that $2.2 trillion valuation. But hey, who am I to decide? What we can do is look into the business side of things. The business of cell phones is unsurprisingly strong. It's almost like we can't live without it. Analysts have predicted for years that Apple's iPhone sales would start to decrease, especially with each generation becoming increasingly more iterative. But it doesn't seem to be the case. While many iPhone users do hold onto their phone longer than they ever have before, a lot of their client base still do pretty frequent updates. And with Apple fleshing out its accessories from the Apple Watch to the iPad to the MacBook to the AirPods, Apple's ecosystem is as expensive and profitable as it's ever been. The ecosystem is so strong it's actually scared Google into worrying about whether the Android ecosystem can even compete. The Android users are going to love that one. Feel free to roast me in the comments below. With the device ecosystem as strong as ever, where does that leave the service business? Apple services actually have the greatest degree of interpretation. Some analysts predict that Apple will eventually compete with Netflix through sheer spending and financial power. Others believe that the only people who subscribe to Apple services are basically getting it for free from buying iPhones and iPads. Both of those statements are relatively true, and to be honest, Apple's service business is still very young and has not been prioritized, meaning that its future is really dependent on how serious Apple takes it. And when I say that, keep in mind, it does still have a pretty big service business. It's no small joke. What investors question is whether it can replace or at least help support any sort of decline in iPhone sales. Because for Apple to have the valuation it does, not only does it need to make a lot of money, it needs to make a lot of money consistently. And that about wraps up the Apple business segment, so let's get into how the consumer electronics industry is looking as a whole. After all, it doesn't matter how efficient you are nor how profitable you can be. If the ship is sinking, you will go down eventually. The consumer electronics space is showing no signs of slowing down either. Despite that, smartphones have been making up a smaller percentage of that overall amount. That being said, Apple is in no real danger from this either as the consumer electronics industry continues to grow, from $422 billion in 2020 to about $500 billion in 2022. With the two largest spending categories being smartphones and laptops and computers, Apple being a big player in both will not have to worry anytime soon. But with the times that we're in, remember consumer electronic devices are part of discretionary spending, and we are going into some economic tightening. Even with Apple's higher income consumer market, this will likely have a significant impact on them as well. Therefore, if you're a short-term investor, it may not be the best bet, but if you're a long-term investor, the overall industry looks very healthy. With the consumer electronics industry taken care of, that leads us right into the overall macroeconomic factors at play. And oh boy, do we have a lot of them right now. Inflation, supply chains, wars, global power conflicts, aging demographics, energy transitions, and the list could go on as long as you want it to. That being said, not all of them have a big impact on Apple. The three most likely to impact Apple are as follows: economic growth, foreign exchange rates, and stability in international markets, primarily focusing on the European Union and China. Economic growth is pretty straightforward. A growing economy makes it easy to make money, while a shrinking economy makes it hard to make money. Foreign exchange rates will primarily hit Apple's services sector. The devices have pretty wide margins and can be offset by pricing, but the subscription services will be a lot more price sensitive. And the last broader economic challenges Apple will be facing is stability in the international markets. A lot of Apple's income comes from both the European Union and China, the first going through a severe energy crisis and the second getting in rocky relationships with the world. Inflation is not a big concern for Apple as it has a wide profit margin and a lot of pricing power. Now, where those economic trends lead from here is well beyond my foresight. But one last economic fun fact, this will be Apple's first economic downturn since the release of the iPhone. For the first iPhone was launched in 2007, and the first mainstream iPhones were launched in the second and third years after that. Therefore, all the success that the iPhone has brought Apple has only been during a growing economy. So this will be Apple's first true test during an economic downturn. Maybe Tim Cook has a recipe for disaster prevention. Just thought you should keep that in mind for any investments you make going forward with Apple. However, in Apple's defense, these are economic conditions that every company are going to have to deal with, and it's going to be a rough period for all of them. So what is the summary for Apple? What is the conclusion? What is the grand picture of this entire investment? Is Apple to the moon or is Apple off a cliff? I'm not answering that directly, because that, my dear viewer, is in your hands. It is the responsibility of every investor to determine what and how and when they make their financial choices. There's billions of people with billions of strategies. That being said, Apple is one of the most financially sound companies on the planet. High revenue, significant profit margins, low debt, a big player in numerous growing industries, and a continuous drive to not only diversify its revenue, but also to increase the consistency of it. And those are the facts, but you can determine whether Apple deserves that valuation, a higher one, or maybe a lower one. As a disclaimer, I'd like to state that I do own Apple stock, and with that could come to some degree of bias from my part. My investment strategy focuses on long-term growth and the profit margins to support not only high dividends in the future, but continuous share buybacks as well. And because of that, Apple has a place in my portfolio. But let me know how you guys invest, and let me know if Apple is a part of your portfolio in the comments below. And as always, support this channel with a like, a subscribe, and keep watching Interesting Investments.